Hey everybody, Brian Shannon here from alphatrends.net. Today's Friday, December 6, 2013, and let's take a look at these markets for the week. The S&P 500 lost just a little bit of ground this week, but the NASDAQ was up at new highs, as were the semiconductors, which broke out nicely. And the Russell 2000, which had been the leader this year, did pull back about 1%. So let's take a look at the charts and we'll see the action here. The S&P 500, you can see, did experience a little bit of a pullback down to that 20-day moving average and closed below it on Thursday. But obviously today we had a gap higher, and this is a scenario that I had outlined in a Thursday evening video for subscribers, that it was possible we were going to get a gap above that 5-day moving average and then to pull back and then close near the highs. So for today's action, it's pretty much what we saw here today. We did gap higher, and a lot of times, when you see a gap of typically more than 1% or so in the S&P 500, we do end up closing near the highs. That's just a observation. I'm not basing that on a study, but it's something that we see quite often when the market recaptures that 5-day moving average upon a gap. So very bullish action today, where we had been kind of a little bit cautious here as the market was below a declining 5-day moving average. I was explaining that meant we needed to be cautious, and you always have to be cautious on any pullback, because you never know if this is the pullback that's going to lead to the top that everyone seems to be trying to pick. It's not our job to try to pick the top of the market, but to prudently manage our positions within a trend. Here's a good little trend line that the S&P 500 had hit on as well. I drew that wrong. It was off of here, but right near that 20-day moving average. More importantly, though, we held above the prior level of resistance. Didn't even come down and test it at that just below 178. So for next week, I think what we would really like to see is for about 180 to hold. If we can stay above that 5-day moving average, then it really sets this market up to continue to hit new all-time highs here. So keep an eye on that 180 level, and some consolidation early next week would be a good thing, I think, if we were to pull back and maybe test the 180 level and test the 5-day moving average. That would really set it up nicely. The NASDAQ was up 62 cents today, and that is a new high here for the year. So this market had really held up much better throughout the week. We saw that, let's take a look at a 10-minute time frame, that the 85 level came down and was tested. We had a little bit of support in there, and it held up much better than the rest of the market. The S&P 500 was selling off. The NASDAQ held its ground, gapped higher today. We had that initial pullback, and we are closing at multiple year highs once again in the NASDAQ 100. So here's basically where we are. We're touching these levels from 2000, and you can't really look at that as resistance. You can't think that anyone would still be holding that had bought back here, that this is their cost basis, but it's just a good reference point to compare how far we've come here over the last 5 years. So the NASDAQ remains innocent until proven guilty. The important level it's going to need to maintain above for the intermediate term health of the market is $85. As long as it does that, it remains innocent until proven guilty. The Russell 2000, this one pulled back a little bit deeper. Let's take a look at a 65-minute time frame. So each one of these candles represents 65 minutes, and there's a blog post on my site about using 65-minute charts opposed to 60 minutes, because there are 6 periods each day that are 65 minutes long, whereas if you're using 60-minute candles, you would have 7 candles for one day, but the first one would only represent a half hour from 9:30 to 10 o'clock, and they need to have 6 candles that are an hour long. This way we have 6 candles that are all of equal length, that being 65 minutes. But we pulled back to this prior resistance area at about 111.5 and came down and tested that 20-day moving average as well. That's where we're getting our bounce from. So resistance is classic technical analysis 101. Resistance broken tends to act as support on pullbacks, and the primary trend obviously remains higher. We came in and tested this trend line as well. So looking to the 10-minute time frame, we gapped up above that 5-day moving average in here as well. The 5-day moving average has a slight decline to it, so I think that a little further pullback while that kind of flattens itself out early next week would really be good for it. and as long as we remain above about 111.40 to 111.50, I think that the Russell 2000 is setting up for another higher high. These are our important higher lows, and we'll want to see this level hold going forward. But right now, our definition of trend remains intact. We're making higher highs and higher lows, and the semiconductors really had the breakout performance this week, pun intended. That it was, we'd been observing the rising 10, 20, and 50-day moving average and how this market was making these higher lows over the last 2 to 3 weeks, and that the level of resistance was really 41.40 to 41.45. Well, we got our break above that, and here let's take a look at the intraday time frame. So unfortunately, it wasn't really because of the gap higher today. There wasn't really a great opportunity to trade it unless you were involved before the breakout, and I generally don't see an advantage to that. If the numbers come out differently today, then the market would have opened maybe down at $40. So what we want to see though for the semiconductors going forward is that if we that this level, this 41.40 to 41.50, does in fact become support. So we'll want to monitor that this week, and as long as it remains above on a closing basis above about 41.40, then I think we would look for the semiconductors to be able to add to their gains at these multiple year highs and continue to move higher. So the financials, this group had, let's take a look at that again. The financials were down 0.5 percentage point this week, so they got hit a little bit harder and haven't quite recovered up to a level that I'm comfortable saying that the buyers are back in control. Really about 21.50 where we had this prior support, and we're looking at a 30-minute time frame right now, and the 30-minute candles are also equally divisible into 13 periods each day. So there'd be 13 candles for each day, and this 5-day moving average would be 65 of these 65 of these 30-minute candles. That represents 5 days worth of trading. So in the financials here, what we see is that we had been trending lower, these lower highs and lower lows. And again, I think it was a gamble if you bought the financials ahead of a number. But if that's your strategy, then I think that's what you ought to do. I'm not here to tell anyone what to do. I'm saying have a strategy, and for me, it's based on market structure and technical analysis to help us determine where the low risk, high potential entries are. So the financials gapped up. They're holding above their 5-day moving average. That 5-day moving average is declining, and we have this prior support in here. So this market's maybe a little bit more neutral intermediate term, but it comes within the context of this bigger uptrend. So it's still, the longer term time frame is innocent until proven guilty. And here's the thing, that if that sounds contradictory, that you have to realize, we can have a market in a primary uptrend, but pulling back, we can be on the sidelines waiting for the evidence that the buyers are back in control. And to me, it's not quite clear that the financial buyers are back in control of the intermediate term time frame that we see on this 30-minute with these 30-minute candles. So overall, though, financials, there's nothing to worry about. They're healthy here. They're in a longer term uptrend on the weekly chart, and coming into this prior area of support from 2008. So it seems to me, if I had a gun to my head, I would buy this. But the fortunate thing is we don't have to have a position. We can wait for the ideal setup. And if we end up missing an opportunity, a missed opportunity is always better than losing money. Let's talk about gold. Gold was down this week, and we continue. I still think that 113 is the level that this market should come down to. A flush of these prior lows would really set it up nicely for the potential of support at that 61.8% retracement we've been talking about all year. The bonds did lose some ground as well, and we've been talking about this head and shoulders pattern, which again, we can take a look at the height of it, which is conservatively measured. We'll call that 131, down to the neckline here at 112. So that would be 19 points tall, and then we take a look at where it broke that neckline at 115 and subtract it from that 115 level, and it would tell us that a head and shoulders pattern would indicate a target of 96 or so. Now, it doesn't mean you just continue to be short the TLT. It means that that's a potential level of support. We're down testing these lows in here, and because the primary trend is lower, it remains guilty till proven innocent. We're below a declining 50, 100, 150, and 200-day moving average in the 20-year bond index. Apple closed lower today. It was down $7.88, but had a great week. That breakout that we were looking at $528 a share did continue well past where I thought it would go. Well, actually, I was saying 550 to 575 was what I was expecting before the year end. So we did obtain that level, and if we look at the weekly time frame, you can see here that from the all-time highs to this year's lows, we're coming close to a 2/3 retracement at 583. But for now, it looks like Apple is in pullback mode, and I would expect to see a little bit further profit taking. It had a great run after that 528 breakout, a beautiful series of higher highs and higher lows, and today it broke that pattern. When we look at the 5-minute time, the 10-minute time frame with a 5-day moving average, you can see that these higher lows have now turned to a lower low, and we have a lower high as well. So for now, it looks like Apple needs to pull back and digest these gains a little bit. The primary trend is still higher, so I would expect that we do find some support, and that it would present another buying opportunity here again in the next week or so. Some of the stocks that we looked at this week, everyone I'm sure had a good week in the market, but even while the market was declining, we were buying a stock like SWKS this week right here as it broke some resistance at $26.80 or so, and SWKS had a real nice breakout from that level. We were also involved in Herbalife on this day, right as it began to move. We got involved in shares of Away. So there's still, even when the market's pulling back, there's a lot of great opportunities in individual names, and that's what Alpha Trends focuses on each and every day, that in education. And by the way, if you have just 30 seconds, please click that link there for on Alpha Trends to vote for Alpha Trends as the educational leader on the Trader Planet survey that'll be closing out here in the next couple weeks. If you enjoy these videos and have learned from them, just take a few seconds and do that for me. I'd appreciate it. Hope you all have a good weekend. Thanks for tuning in.